Getting back to one of the major items that we're tracking, our next guest says he doesn't see a reason for financial conditions to tighten much more. 22V Research founder Dennis DeBuscher joins us now. Dennis, walk us through your thesis. Why do you believe that financial conditions won't tighten much more from here?
Yeah, so it's a good question because the economy is clearly slowing. So when you look at underlying demand, and the New York Fed has a great index of this, their weekly economic index, you've seen a significant shift lower over the last couple of months. It has been decelerating for a while, but now you've seen a significant shift lower. And as demand growth moves aggressively below trend, you should see some loosening up in the labor market. So the question now is not whether or not financial conditions need to tighten more or less. The question now is what's the impact on the economy longer term, and will we be able to avoid a hard landing? So I don't think financial conditions are going to ease, by the way. I just don't think they're going to tighten. They're going to stay around this level. And as they stay around this level, you're going to see the economy continue to slow fairly aggressively. We'll see if we go into, a recession, hard recession, whatever. And now it's really about the E. And it's about how that plays out over the course of the year.
And something you pointed out, Dennis, in your daily note is that even though we are seeing all of this commentary around the economy, the consumer confidence, the number that we got yesterday from the Conference Board, was actually pretty darn good. And that confidence is tracking more with inflation than it is with the overall economy. What are the implications of that for consumer spending and then for the economy going into 2023?
Yeah, confidence has a very poor record of actually predicting spending. And so one of the things we noticed is that over the last year, as the economy was ripping, right, you had fiscal stimulus, then you had credit creation, you had very strong spending numbers, and consumer confidence plummeted because inflation went higher, which is a long way of saying people hate inflation. So now you're seeing inflation expectations come down, confidence increase. But as the unemployment rate starts to move higher, you can be rest assured that people will stop focusing on inflation and start focusing on jobs as a reason to be upset. And that's going to have the biggest influence, meaning the unemployment rate, on actual spending. So demand growth shifting lower, the unemployment rate moving higher, the labor market in general just loosening up is going to lead to significantly lower retail sales over the course of, certainly the first part of next year.
Dennis, are the lows for this cycle in the markets in?
I think the odds are that they are. I mean, I would say my confidence in that is not, 100%. I would say maybe 60% odds that the lows are in. I think we're more or less in a range of kind of 3,800-ish on the downside, 4,200-ish on the upside. I'm not excited about being short the market at 3,800, just from a money-making opportunity point of view. Yeah, clearly it could go lower than that. But unless you have a lot of confidence that earnings are going to be substantially lower than what the buy side is expecting, and I don't think that the odds of that are high, it's really tough to be too negative around the 3,800 level. And I would say, when I say the buy side, forget the sell side, because everyone talks about the sell side estimates. When we survey investors, the median expectation for earnings next year on the S&P 500 is 220. So a lot of the negativity on earnings, I think, is factored in. It's just a matter of you get significantly below that.
Dennis, with the thesis that you've laid out, what is your big idea, your top idea for investors who are looking for solid returns in 2023?
Yeah, good question. Early cyclicals relative to deeper cyclicals. The economy is going to slow. And when I say early cyclicals, that's going to be tech discretionary over things like industrial materials and energy. So that is the idea over the course of the year. Now, I'm not a total idiot, hopefully not. So it's going to be difficult for that to work potentially over the first 3 months, because we're going to be going through the worst part of the slowdown in economic growth. But if you look over the span of the year, I think early cyclicals have a very good chance of outperforming deeper cyclicals. And then I would say cyclicals in aggregate will outperform defensives. So your staples, utilities, healthcare, REITs, which have extraordinarily high valuations, both on a relative and absolute basis, are just way too expensive unless you have a very hard landing in the economy. We're not calling for a very hard landing.
What are you most worried about going into 2023? Is it the prospect of maybe a hard landing, or what are you sort of keeping an eye on?
I guess what I'm most worried about, it would end up in a hard landing. What I'd be most worried about is being dead wrong on spending growth the next 3 months and the Fed having to do a lot more. So I made the point earlier that financial conditions don't necessarily need to tighten a lot more from here. But if it's proven out that they do, because spending growth continues to accelerate or remain too strong, and this is very important, the labor market doesn't loosen up, So maybe you see claims start to move back down. Maybe you see the unemployment rate not move higher. It's clear that the Fed wants the unemployment rate higher. If that were to happen, then you could expect the federal funds rate maybe to go a little bit higher. And the federal funds rate has to go a little bit higher when the economy is already slowed. I mean, the odds of a harder landing, increase. So that's the biggest risk in our view.
22V research founder Dennis DeButcher, always good to see you. Happy holidays.
Yep, good to see you. Thank you.